Good evening, Paula. Good evening, Lorraine. And anybody else who's out there listening to us who's just logged in. My apologies for the slight delay to the start this evening. But I'm here, I'm ready, and hopefully you guys are as well. So, 24 hours ago, 24 hours? 48 hours ago, we dealt with the critical topic, I should say, of business finance. This evening, in the plan, as I forewarned you, we're going to do valuations and risk management. Now, in the context of this paper, where do they sit? Well, risk management and valuation will not be appearing in syllabus in section C of your exam. It's not going to be appearing in section C of your exam, so it's not one of the core topics, but I understand for many of you it is one of the topic or two of the topics that cause you the most distress. It's going to be in section B, and I've got a plan of the questions that we look at tonight. Question for Paula and Lorraine: where should we start? Which is the one that causes you the most concern? Is it valuation techniques or is it risk management? If you let me know, then I will prioritize and start that particular topic. So just type into your keyboards, is it risk or valuation? Valuation. Okay, Lorraine, first off the button. Valuation. What I'm going to do then is, there are 5 techniques. Okay, 5 techniques. Let's just refresh your memory of these techniques. And if I come to this revision plan, and forgive me, there has been a bit of, oh, here we are. So, valuation, essentially 5 techniques that you need to be able to complete. I want to make sure that I have chosen questions which enable us to just see that in exam context. But you need to be able to use the dividend valuation model. And here, to establish the price of a share, what we say is the price of a share will equal the dividend multiplied by 1 plus growth divided cost of equity minus growth. Now, that is essentially a perpetuity calculation. We are discounting a dividend by the cost of equity. We are suggesting that the value of a share is essentially the present value of future dividends, but we incorporate the growth as well. This is perhaps one of the least useful measures for value in a business because the dividend does not necessarily grow constantly, and neither is the dividend a reliable indicator of the future. It may not always be paid. We'll see some calculations on this. The asset-based book or realisable value, or even replacement, the NAV, the net asset value, will equal non-current assets plus current assets minus current liabilities minus long-term debt, including preference shares. And in one particular exam, goodwill as well. Here we have got a statement of financial position which you must extract those numbers and do that necessary calculation. I've got some questions lined up for us on those. Income-based measures, we've got the price-earnings ratio. And for the value of a share, the PE ratio will simply take the earnings per share and multiply it by a PE ratio. Or if it needs to do it in total, it will take the total earnings times the PE ratio. With the earnings yield is a perpetuity. So the earnings yield method, what we do here is we say the earnings, or the earnings per share, depending on what we have, divided by the required yield. Finally, the discounted cash flow, the value of the business is simply the annual cash flow divided by the weighted average cost of capital. Now, I'm pleased to say, you can't see what I'm writing. Absolutely, I apologise. There we go. Forgive me. Let me just explain what I've written. For the dividend valuation model, the dividend valuation model, the dividend multiplied by 1 plus growth divided by cost of equity minus growth. The net asset value is non-current assets plus current assets minus current liabilities minus long-term debt. The price earnings ratio is simply the earnings per share or the total earnings times the P/E ratio. The earnings yield is the earnings divided by the required yield, and the discounted cash flow is the annual cash flow divided by the WACC. I am going to just focus on that for a moment, and of course the market capitalization is current share price multiplied by shares in circulation. And what I would like to do, because I feel this is perhaps the best question, is to take us to one from the revision kit. And when I say the best, the most comprehensive, and enables us to see all of these in tandem. Then we will go to a question from the June 15 paper, and then I'm going to do a variety of multiple choice questions that will facilitate and enable me to tick off all of the elements that we have here. So, where do I want to go first? I want to go to the revision kit itself, which disappointingly doesn't appear that I have got ready for you. I will open this very quickly. Now, in your revision kit, around about page just need to shrink this ever so slightly. There we go, that's better. Almost there, apologies for this. I thought I had this open and ready. So, from your revision kit, there is a question called GWW, which happens to be a question from 2009, and it's here. So, question 64 in your revision kit, which is on page 173. You don't need to go scrambling for it now, but can you just read what's on the screen? And I'm going to demonstrate how we calculate each of these valuation techniques for you. So let's read it together, shall we? GWW is a listed company which is seen as a potential target for acquisition by financial analysts. The value of the company has been a matter of public debate, and we have got our earnings provided for us here. Our earnings are currently 10.1 million. And we've got historic earnings of 8.5 million, which actually we don't need. We've got total dividends, we don't need to worry about dividend per share, that are currently 6 million. Historically, we'll need to know were 5 million, and that was 3 years previously. We then have a statement of financial position, and we are told non-current assets are 91. Inventory is 3.8, receivables is 4.5, non-current liabilities are bonds of 25, and current liabilities are 7.1. Now, so far we've got earnings, dividends, and a statement of financial position, which gives rise to the P/E ratio, the earnings yield, the dividend, and the net asset value. The only thing we cannot do in this question is the discounted cash flow. Then as we read, we are told that the shares of this company currently have a par value of 50 cents. Well, if we come up here and we look at the ordinary shares of $20 million, well then the shares in circulation that would be 20 million divided by 0.50 equals 40 million. And they are currently trading, or they currently have a market value of $4 per share. The cost of equity of the company, the cost of equity is 9%. The business sector has an average price earnings ratio of 17. I shall ignore this information for the time being. And then I come down here and we can see the net realizable values of the non-current assets in the inventory are 86. So, if I may, I'm going to just, that figure becomes 86. 4.2, inventory will be 4.2. And liquidation, only 80% of trade receivables, so 80% of this figure gives us 3.6. Non-current assets plus current assets gives us a total of, please say I brought my calculator. I cannot believe that I have not brought a calculator. Here it is. Non-current assets are 86 plus current assets plus the other current, 93.8 million minus Dean's liabilities, 77.1 and 25. I can already see that our net asset value is 61.7. The share price is $4, so we have 160 million. Okay, 160 million, 61.7, recognizing that non-current assets plus the current assets minus the current liabilities and minus the long-term debt gives us 61.7. I'm going to write this up more clearly now, and I'm going to just do part A of this question. We will come back potentially and do these other parts, but for here we are required to calculate the value of GWW using the market capitalization and the net asset value. Well, actually, hopefully Lorraine and Paula, you have already seen that that was simply 40 million times $4. That gives us 160 million. And the net asset value, as I worked above, is 61.7 million. Okay, 61.7. The price earnings ratio, well, we've got earnings of 10.1 million and we've got a P ratio of 17. That gives us 171.7. Yes, 171.7. So the business is currently trading at 160. The realizable value of the assets is 61.7. And the price earnings ratio suggests the company is worth slightly more than its market capitalization at 171.7. That is relatively straightforward. The complexity in this question, I believe, is the dividend growth model, because you have to find the historic growth rate using the average and Gordon. For that, I will take a little bit more care. So, what do we have here? The average growth will be found as the current dividend divided by the historic dividend divided to the power of 1 over n minus 1. Well, in this question, it said the current dividend, and we're doing this in total, is 6 million. Historically was 5 million, and that was 3 years ago. So on our scientific calculator, 6 share by 5 to the power of 1 share by 3, that gives me 6.27%. And therefore, the value of the business using the dividend growth model, sorry, I need to get the air conditioner on in here. It doesn't want to work. There we go. So the value of the business is the current dividend multiplied by 1 plus growth, growth being 6.27%, divided by the cost of equity, which we read in the question to be 9%, minus 0.0627. That comes out at 233.6 million, which is way in excess of the market capitalisation. Not really reliable because the dividend may have been distorted or increased. The growth makes this very sensitive, as you shall see. Now, Gordon's growth, what this requires is for us to find the return on equity and multiply it by the percentage of funds retained. Now, the return on equity equals the earnings divided by the equity, book value. So the earnings were 10.1 million, the equity book value was 67.2. That gives us 15%. And then the dividend payout percentage equals the dividend divided by the earnings. Well, the dividend was 6, the earnings was 10.1, so that comes in at 59.4%, which means we must have retained 40.6%, which means our growth, according to Gordon, is 6.9%, 6.09%. Now, you could argue, and this is where rounding could cause problems, that it's almost the same number, but just that slight difference, that 0.18, will have an impairment of this value, as I shall show you. Using Gordon, the value is 6 million multiplied by 1.0609 divided by the cost of equity minus 0.0609. So 6 times 1.0609 divided by 0.09, that comes in at 218.7 million. So just that very small change in percentage erodes the value from 233 down to 218.7. Let's let that reflect. Okay, from this early introduction, we have now seen calculated for you an asset based on realizables, a dividend valuation model with both Gordon and average growth, and a PE ratio. We've also seen a market capitalization. I want to make sure before we proceed that we can comfortably register all of these. And the next question I'm going to subsequently take you to is from June 2015. I may come back to GWW at some stage, but for now I want to get the earnings yield attempted. So if I take you to June 2015, question is number 2, which is called Chad. Have a read. Chad is a stock market listed company which has managed to increase earnings over the last year. As a result, the board of directors have increased the dividend payout ratio from 40% to 41.4%. Chad has a cost of equity of 12.5%. We might as well, whilst we're here, do the equity market value using a dividend growth model. There was some concern with this question, but what you had to appreciate is 40% of the earnings, so 13,200,000 times 0.4, meant that the dividend paid in 2014 was 5,280,000. Further, 41.4% meant that the following year, 13,840,000 times 0.414 was a dividend of 5730, which means it's grown by 450 in percentage terms. 450 shared by 5280 gives us 8.5%. Okay, the growth here was not 1.4% as some candidates assumed, because 40 to 41.4. You had to calculate the dividend. In 2014 it was 5280. In 2015 it was 5730, meaning that it's increased by 450,000, which is growth of 8.5%. And subsequently, the dividend value for this business, based upon the most recent dividend of 5730 times the growth of 8.5 divided by the cost of equity minus the growth, equals 155.4 million. 155.4 million is the dividend value. Now the beauty is the equity market value using the earnings yield is exactly the same way. The earnings yield, arguably, you could just say 13,840 and divide it by the yield of 0.82 and you'll get a similar answer. Comes in at 168 million. 168.8 million. £168.8 million. But I disagree with the examiner's answer, and I have asked the examiner about this, and he agreed with me. This grew by 640, which divided by the base gave us growth of 4.8%. So look what's going to happen. Our figure is going to grow rapidly, but I believe that we should calculate this incorporating that growth of 4.8%. And when we do, get a much bigger figure. we get 13,840 times 1.048 shared by 0.082 minus 0.048, 426.6 million. Both of these answers are totally acceptable. So we've calculated the equity market value using the dividend growth model. We've calculated the equity market value using the earnings yield. Discuss the relative merits of the dividend growth model. I shall do that with you shortly when we come to look at the writing. But for now, I want to do one more thing just to complete the set. And that is to take you to the most recent exam, which is in December 2016. December 2016's paper, September 2016, I apologise. Here we've got question, yes, question 9. Can you see that okay? Have a read of question 9. This is September 2016. A company has after-tax cash flows of 2 million, which are expected to continue into perpetuity. This is a perpetuity formula. The company has a cost of equity, irrelevant, a before-tax cost of debt, irrelevant, and an after-tax weighted average cost of capital, 8%, relevant, corporation tax, irrelevant, because it's already after tax. So if we divide that by 8%, we will get 25 million. 25 million subsequently is the value of this business using the discounted cash flow method. That is the only time I have a question that I can locate in a recent F9 exam. What I am now comfortable is you have been introduced to each of these methods. Paula, Lorraine, are you happy for me to now proceed to the market value of debt, as we have seen the 5 ways in which you calculate the market value of equity? Is there anything from those that you would like clarification on? Okay, fantastic. I'm now going to try to find, and there isn't that many of these questions, the market value of a preference share. To be truthful with you, there isn't one off memory, so I'm going to make an example up. The most, and for redeemable as irredeemable as well. When you're in an exam situation, we find that the redeemable and the convertible are the ones which get frequently examined. So I will come and find some questions on those. The market value of a preference share is simply a perpetuity formula. There is no growth because the preference dividend is fixed each year, and if you were to see in a question a 5% preference share with a nominal value of 50 cents where investors' required return is 4%, then the value of a preference share is simply the dividend divided by the required return. Well, 5% times 50 cents equals 2.5 divided by 0.04. That would give us a value of 62.5 cents. And the logic here is that because the preference share gives a 5% return when the investors only want 4%, then it's trading above its nominal value. It's trading above its par value. If it was the other way around, it gave a 4% dividend, let's say a 4%, and the investors required a 5% return, well, sorry, a 4% would clearly give us a dividend of 2. Look what happens in this instance. It reduces to 40 cents. So logic should guide you. If the investor's required return is greater than the actual dividend that is paid, it will be trading below value, below its nominal value. By contrast, if the investor's required return is lower than the dividend percentage, it will be trading above. And that principle in essence works for all of these debt calculations. When we look at bank loan, it goes without saying, you cannot buy and sell bank loans, so it doesn't have market values. It's always valued at its book value, as you hopefully recall from cost of capital. But when we're looking at loan notes, what we essentially must do is we discount the investor's cash flows at the pre-tax cost of debt. And the investor's cash flows, we discount the investor's cash flows, which are also pre-tax. The investor's cash flows are pre-tax, we discount them at the pre-tax cost of debt. Now, as I stress, irredeemables are hard to find. Oh, what happened there? An irredeemable will simply equal the interest in dollars divided by the pre-tax cost of debt. Also known as the investor's yield, or even the investor's required return. So if we had a $100 nominal value and it had, let's do what I did before, a coupon rate of 6% and the pre-tax cost of debt equals 8%, then we're looking at $6, because coupon rate of a $100 loan note is essentially the same thing, divided by 0.08. This will be trading at $75, below par. Spin that around, if it was an $8 coupon rate and investors required only 6%, then we're looking at 133.33. So again, the logic determines the value. Where the investors are not getting the return they require, where the coupon rate is lower than the required return, it trades below its nominal value. But where the investors are getting a return in excess of what they require, it trades above market value. That's an irredeemable. For a redeemable or convertible, essentially what we've got is two cash flows. We have annual interest, which will be paid not forever, it's not of perpetuity, but for a finite life. So the annual interest we discount using an annuity table. And then we add to that the amount repaid or converted which we discount as a one-off. Now, with a convertible, you have to decide whether the investor will redeem or convert. And we've got a question in that September paper that I'm going to use to demonstrate how we do this calculation. So we're going to go to page, well, it's back to the September. Down to question number 11. I'm going to ask you to have a read of question number 11, please. Okay, examiners put in corporation tax, that is not relevant. What we know is that in year 1 to 5, annual interest will be paid at $3, and we're going to discount that using our annuity tables for 10% for 5 years at a discount factor of 10%, which is 3.791, giving us 11.37. And then in year 5, we do not know, but we're going to discount using 0.621, which will give us a figure that will enable us to establish the value of this loan note. What we must do is we must decide, will the investor redeem or convert? So, will the investor, it's the investor's choice, not the company. Will investor redeem $100, or will the investor convert for 25 shares? Now, these 25 shares are at their future value. So we have to do a little bit of compounding here. The current value per share multiplied by 1 plus growth to the power of n equals the future value. The current value per share is 360. growth is 5%, and this is for 5 years. Now, this is very particular here because I would ordinarily round my answer off, but I can't because it will not match the answer given. But 3.6 times 1.05 to the power of 5 comes in at 4.5946136625. That figure in my calculator I then multiply by 25 and it gives me 114.87, rounded now. So what would you do? 114.87 versus 100, of course the investor will convert because it is the most lucrative return to them. So coming back to the question, the 114 they are going to convert, and I'm going to get rid of that. That's going to be 114.87 times 0.621 gives me 71.33 plus the 11.37 gives me 82.70. Now you can still see there's a bit of rounding, but the truth is, folks, it's fairly obvious which the answer should be. The answer is going to be A. I'm 1 pence out. I'm 1 pence out, but the answer is A. 82.71. Okay, now what have I got lined up next? We have subsequently seen a redeemable. Have we seen a redeemable? No, we've seen a convertible, but it's the same principle for a redeemable, except you just use the standard 100, or if it's redeeming at a premium, whatever that figure may be. In terms of the efficient market hypothesis, you've got to recognize that this is the way in which information is absorbed into the share price. According to the weak form, information is not absorbed into the share price as it becomes available. Rather, it is based upon historic announcements by the company. Under the strong form, information is immediately absorbed into the share price once it's created. And under the semi-strong form, information is only absorbed into the share price once it becomes publicly available, which is the most robust of the three. Now, whereas my weekend class are very apprehensive about valuations, I don't want you to worry too much. And I told them the same thing, because valuations is not a Section C written question. It's a Section B multiple choice. And from the 45 minutes that we've been spending on valuation so far, I now believe that you can actually do a real exam set of 5. So in September 2016, Section B contained a scenario called Ring. Now I'm hoping that you have access to this, but there we have the questions. Can you see all of those? It's very small. Whilst you're online, go to the ACCA website and do a Google past ACCA F9 exams and open up the September complete paper, September 2016, because I'm going to have a break and I'm going to hand this over to you, and I am confident that you can get these questions correct if you just look at the methodologies that we've been using so far this evening. I don't want you to look at the answers because that defeats the object. I want you to apply yourself to these questions, and I'm confident that you can get at least 3 of them correct. So, is 10 minutes long enough? Perhaps not. Dare I give you 15 minutes? I'm going to give you 15 minutes, which is far less time you'd have in the exam. But I want you to open up this, and I want you to demonstrate to yourself that you have nothing to concern yourselves with. Can I put up Question 11 computation. Of course I can, Lorraine. Question 11 computation. Do you mean that element? Or did you mean the working that I did elsewhere? Is that okay? Do you mean that element there? You only do that for a convertible. If it is a normal redeemable, you don't have to go through the redeem or convert option. You simply recognize it will convert, it will redeem at whatever figure is told. Sorry, the question paper bit. There we go. For the question 11, this is my this is my solution. We're working on a time delay here, slightly. I'm assuming this is what you're after. Correct answer is, great. The correct answer is A, which is very, very close to that answer. But that's the approach there that you would use for a redeemable, except it would just say redeem at $100. Okay, can I move away? On Saturday, I gave this to my class and I said they should get 2 correct. With what we've done this evening, I believe you should get 4 correct. So as I say, I'm going to leave you for 15 minutes. This is a real exam and this is how you're going to be faced with valuations. So I'm going to leave you for 15 minutes. Don't look at the answers because that defeats your learning. Try them. If you're unsure, make an assumption. Nobody's looking at how you've performed. We're not worried. We want you, or I want you, to be confident in what you're doing and that you understand the approach. So over to you, and then after we've done this, we'll have a view of whether you still feel apprehensive about valuations. Okay, 15 minutes, guys. 4 correct answers, 8 marks in your exam, coming right up. 5 more minutes and you're going to have 8 marks in your exam. Okay. 15 minutes is not a great deal of time, but I'm confident from what we've covered tonight that you're going to be capable of answering these correctly. Real exam from September. We had a scenario here about a company that has ordinary shares in circulation with a nominal value of 25 cents. The shares are traded on an efficient capital market. It shows it is now 2006 and the company has just paid a dividend of 45 cents per share. Just there. Recent dividends, so 1, 2, 3, 4 years ago, the historic dividend was 37. Ring also has in issue loan notes which are redeemable in 7 years at their nominal value of $100 and they pay interest of 6%. The finance director wants to determine the value of a company. They have a cost of equity of 10% and a before tax cost of debt of 4%. Corporation tax of 25% is the red herring. So what do we need here? We need to do two things. We need to calculate growth. Well, growth will equal 45 over 37 to the power of 1 over 4 minus 1. We're looking there at growth of 5%. So what is the market value of each share? We're going to use dividend per share rather than the total dividend. 45 cents times 1.05 divided by our cost of equity of 10% minus 0.05. Well, that comes in at $9.45. $945, $9.45. That is a lovely question, I feel. 2 marks in the exam. Set your mind at rest. What is the market value of the loan note? Well, in year 1 to 7, there's going to be interest here. Interest of $6. And then in year 7, it is going to be repaid at $100. There's your cash flows. And your discount factor. What's the discount factor? It's going to be 4%. So go into my annuity table. 4% in 7 years is 6.002. And 4% 7 years is 0.76. So 3601 and 76 gives me a total of 112.01, and there is my answer, just nestled in there, 112.01. Oh, the tax is a red herring. This is a real exam. The questions are, I feel, very pleasant. Now, this one you've got to take your time on because it's playing on words and it's going to detract from your awareness. The finance director of Ring has been advised to calculate the net asset value of the company. Well, as soon as you see that, remind yourself, net asset value is non-current assets plus current assets minus current liabilities minus long-term debt. And current assets minus current liabilities is what we know as net current assets. So non-current assets plus net current assets minus long-term debt. Well, here, total assets would be non-current assets plus current assets. Minus current liabilities is not the correct answer because it's ignoring long-term debt. So it cannot be that answer. Non-current assets plus net current assets is wrong because of the same reason. Non-current assets plus current assets less total liabilities, that could be the right answer because that there is total liabilities. So non-current assets plus current assets less total liabilities. But don't answer that yet. Let's just double check. Non-current assets less. No, it's not less net current assets. So guys, our correct answer is C. We move on. 24. The following statements about valuation methods is true. Now these questions, as I say, don't allow them to overwhelm you. Don't try to answer them too quickly. Take your time. The earnings yield method multiplies. Well, earlier on this evening, we did an earnings yield. Where did we do that earnings yield? Is it this one? Yes, that wasn't a multiply, that was a division. That's a division, hence that's not the correct answer. The equity market value is the number of shares multiplied by the share price plus the market value of debt. No, the market value of debt would ordinarily be deducted. That is not the correct answer. The dividend valuation model makes the unreasonable assumption that the average dividend growth is constant. That's exactly what it does, but I'm not yet prepared to answer C. The price earnings ratio method divides earnings by the price earnings ratio. Well, folks, again, this evening, when we did the price earnings ratio, did we divide? No, I think you'll see up here, if I can find it, nope, or maybe on the revision kit here, we didn't divide it, we multiplied it. So that is incorrect. Our correct answer is C. Those were the four that I thought you should get correct. Now, which of the following statements about capital market efficiency is or are correct? Insider information cannot be used to make abnormal gains in a strong form is correct because the strong form absorbs all information as it's created, so nobody has a head start and has information that nobody else has access to. Under the strong form, everybody has access to the same information regardless of whether it's publicly available. In a weak form efficient capital market, Ring's share price reacts to new information the day after. No, it doesn't. In a weak form, it doesn't react to the new information. Ring's share price reacts quickly and accurately to publicly available, known as newly released information in a semi-strong. Yes, it does. So our correct answer there is not A, it is B. 1 and 3 only. Okay, guys, we have, apologies. Paula's not here, she's disappeared. When I checked before I came in, it was Paula and it was Lorraine. But I checked just a moment ago and it's Lorraine and Mwemba. So hello, Mwemba. I apologise if I didn't refer to you earlier. I didn't know you were logged in when I started. This evening, we've got to do valuation and risk. We have 2 hours and a half with the break that I'm being instructed to take. So we are halfway through our 2.5 evenings, 2.5 hours I should say, and I just want to reiterate that in my mind we have covered everything there is to know about valuations and we've seen it in real exam context. My final question therefore to you guys, Mwemba and Lorraine, is, and what have we looked at? We've looked at GWW, we've looked at Ring, we've done a few other multiple choice questions. We did as well just dip briefly, did we not, into Chad, but I didn't do the written question because I don't believe written questions will be required to do with valuations. Can you indicate to me please, Mwemba and Lorraine, if you are now happy and satisfied with valuations? And if you aren't, what further clarification would you like? In the absence of any response, I can only but assume that you are both delighted with valuations and are happy to move on to risk. Last chart. Yes, brilliant. Mwemba, you're satisfied. Fantastic. Lorraine, if you're still with us, I am assuming you are satisfied as well. So this is where we're going. We're going to you absolutely need to go through we've done. And if you have any issues that you have, please email me. Subsequently, I'm demonstrating how to apply your knowledge to questions. I don't for one moment believe you're ready to sit the exam, but hopefully I've broken any barriers you've got to digesting this. So yes, work upon these, and on that point, you know, all of these questions here are worth looking at. Dargler, Parr, maybe Corhig as well would be my preferred questions. So 7:20, we're an hour and 20 minutes in. We've got an hour and 25 minutes left, but with a break to take. We're going to come back and do risk management. Go and put the kettle on, guys. Have 10-minute break. What I would like you to type up, though, is the things that you really are nervous about, because as you can see, risk management slightly larger in coverage than it is valuations. I am going to take the same approach, what I've just done with valuations. We're going to look at some MCQs, we're going to look at some bigger questions, but critically, so I can address your needs. What during break, if you can quickly type up for me the things that you really want to prioritize, then I will look at those first. Otherwise, I'm going to have a sit down. I will come back in 10 minutes time and we can take it from there. Okay? I don't know why I'm looking at that screen. I should be looking at this screen. See you in 10. Have a think about this topic. Amazing. Davidzo, good to hear from you. Let's have a read of what's going on here. Conversion rules, buy and sell issues. Could you brush up conversion rules, buy, sell, and hedging calculations? Good session so far. Right. Let's have a little look. Absolutely. I will ensure that we cover those, and I've got a number of questions lined up. Just you know, put this all into context. We find ourselves in the modern F9 or the current F9 examining philosophy that foreign exchange is no longer going to be Section C material, it's Section B. That means there's no writing. It means it's multiple choice, which is great because it's not a well-liked topic. But for me, it creates a problem because some of the hedging calculations that we're required to do are difficult to do in a 2-mark question. Now, what we should do, I'm going to have a chat through this list of things that could come your way, and then I'll highlight some of the more important questions that I feel. But absolutely, we will be doing conversions and hedging. Now, you must recognise that there are 3 types of risk: translation, transaction, translation, and economic. A transaction risk arises due to the time delay between entering into a trade and settlement of that trade. So if we sell a product and we sell it to a foreign customer who will pay us in their own currency, meaning that we take on that risk, the transaction is agreed but not paid by our customer for however long, a month, 2 months, 3 months, and we are concerned that the FX rate could be moving adversely during that time. It's not because we are trading with a foreign customer, because we have absolute awareness as we make the trade of how much we will receive, but by the time we receive it, it could have deteriorated. That's the transaction risk, the time delay. The translation risk, this is simply an accounting risk, no cash impact, but it's where a business has an overseas subsidiary and at year end, when they consolidate group accounts, there will be deterioration in assets and liabilities, or an enhancement of them as well, because of foreign exchange movements. And finally, the economic risk is a series of transactions. It's a longer term risk that a business will face. So right now for the United Kingdom to trade with Europe is an economic issue because the pound has devalued against the euro in recent months. Foreign exchange theory and forecasting, purchase power parity theory and interest rate parity theory work in exactly the same way. They suggest that the future exchange rate will change according to the relative interest and inflation rates between the two nations. And in essence, what they suggest is the nation with the higher interest or inflation will see their currency devalue. There is a formula given for this for you to apply. Conversion rules. Now, I've studied F9 past exams, and we don't really get anything that overly complicates the issue. So what I would advise you to do is you look at the domestic currency of the company in question, and then you subsequently recognize that they will be buying the foreign currency at the low rate and selling it at the high rate. Because that, for me, makes logical sense for you to recall in your mind. Buy low, sell high. I'll demonstrate this to you when we look at a couple of questions. Now, if you're ever asked, and there is questions out there to discuss a practical or an internal method of managing the risk, the classic one is just to simply refuse to trade in another currency. So if we are selling to this customer in Europe, they have to pay us in sterling. They take the risk, not us. The problem with invoicing in your domestic currency is that it erodes your competitive advantage. So for instance, imagine you're an airline, and you're an airline that operates globally, and you insist that all your customers pay you in your currency. You're not going to be that competitive. So wherever you are in the world, if you get on an aeroplane and go to another country, you will normally pay you as a customer in your own currency because the airline wants your business. Netting is where we look at offsetting Any well, actually, let me rephrase that. There is two things to be referred to here. We could have, let's put another one here, match-in. Match-in is where we offset income and expenditure. So the airline that operates in America that is based in the United Kingdom, British Airways, they will receive dollars from their customers flying out of America. So what they do is they match their income with expenditure, and they pay their staff locally in dollars, and they buy supplies in dollars. So they don't need to keep acquiring dollars and selling dollars, because they simply have a US dollar bank account and they match income and expenditure. Netting, on the other hand, is where we've got subsidiaries owing each other money. We net them off to reduce the number of transactions. Lead-in is to pay early, lag-in is to pay late, and doing nothing is simply to take the risk, absorb the risk, and hope for the best. What hedging techniques, remember, I think you were referring to, is the forward exchange contract, the money market, and the derivatives. I will explain these as we deal with them in a question. Then, please don't ignore the fact that we have interest rate risk, and you need to know about interest rate theory, the yield curve. The yield curve is normally upward sloping, and the slope depends upon the expectations. If you expect interest rates to rise, it will be higher. If you expect them not to rise, it will be a lower curve. The market segmentation theory, let me explain liquidity preference first. Liquidity preference says the longer you deprive an investor of their funds, the higher the return they want, which is absolutely true. But market segmentation says that there are different markets, and subsequently an unsecured loan would demand a higher return than a secured loan. Finally, interest rate hedging, you've got to be able to deal with forward rate agreements, and I'm going to look at a question there. Derivatives to a lesser extent. Now, matching, by the way, is getting borrowings and savings at the same time. Guys, I want you to appreciate this. In section A of your exam, the ACCA now have pushed the boundaries to the limit. And I have found questions in section A of the exam that I find really complicated. And rather than enhance your already anxious state of mind by telling you that you have to go away and learn all of this, my view is you maximize your return in section C of the exam, as I hopefully explained to you on Tuesday. You produce a fantastic performance because we know it's investment appraisal, working capital, or finance. You produce a decent return in the mini scenarios in section B, of which I just left you with one to work upon. And then in section A, you just stream the questions to try and find one or two that you like. So with our hour, I am going to hopefully do just that. Go and find some questions, or not just the questions we like, but I'm hopefully going to go in and find a range of questions to cover a number of these elements. I'm going to start off with a bigger question before we squeeze down. So the one that I wanted to do first is December 14 paper. Why did I say the December 14 paper? PZK. Yes, okay. Let's have a read of this. It's just got a number of things in here, PZK. Let me leave you to digest that, and I shall answer it for you. But have a read, PZK. Okay, so guys, I've got questions I want to perhaps extract just for coverage here. So I'm going to start with PZK. PZK is a company whose home currency is the dollar. That's important. That's our domestic currency. They trade regularly with customers, so customers will pay us in a number of different countries. The company expects to receive in euros 1.2 million euros, crucially in 6 months' time. So we're going to have a receipt. If we receive euros, what do we want to do? Well, we're going to sell them. And we sell at the high rate. So remember, the high rate is what we're going to sell at. The low rate is what we would buy. We would buy euros if we had to make a payment. We are going to sell euros because it's a receipt. We don't want them, we want dollars. Current exchange rates are given as follows. We've got a spot rate of 4.208. We've got a 6-month forward rate of 4.2606. Now, just looking at that, it appears that the euro is devaluing. And why is the euro devaluing? Because that number is rising. It becomes more expensive to buy a dollar. And when we sell at a higher rate, you'll see we'll get less money. Calculate the loss or gain compared to its current dollar value, which PZK will incur by taking out a forward exchange contract on the euro receipt, and explain why this may be preferred to not hedging. So the reason I started here is because this is a forward exchange contract. A forward exchange contract is inflexible. We are committed to it. We have been offered a guaranteed rate of 4.206 in 6 months' time. However, that is a risk, because if our customer doesn't give us the 1.2 million euros, we will have to buy them and then sell them back. The inflexibility of this forward exchange contract is why it is not liked, but it provides us with certainty. So let's show you the calculation. The current spot rate says that 1.2 million euros at this rate of, where are we looking? What is our current rate? I've lost the question. Bear with me a moment. In fact, we are looking at PZK December 14. Okay. I apologise, guys. Bear with me. PZK is here. So the rate we are looking at is 4.208. What's that going to yield us in dollars? 1.2 million shared by 4.208, that's going to yield us 285,171. The forward, what's that going to generate for us? 1.2 million euros at the rate of 4.2606. That's going to yield us 281,650. Therefore, we have a loss of $3,521. The examiner's asking us, why on earth then would we proceed with this forward? Well, the spot rate is governed today. And in 6 months, the rate is highly likely to change. And the risk here is that the rate will move in an adverse manner. Thereby, the forward provides absolute certainty. The forward provides certainty. That's why it's acquired. So the only concern we have thereafter is the customer doesn't pay us, essentially. Right, next. Okay, let me show you something here. You are aware you get a formula sheet in the exam, and in your formula sheet plenty of formulas, some of which I don't worry you about because I think they're overly complex. But look at this, down here, can you see this okay? Purchase power parity theory, interest rate parity theory. The future rate equals the current rate multiplied by 1 plus IC divided by 1 plus IB. Or the spot rate in 1 year equals the spot rate today multiplied by 1 plus HC, 1 plus HB. The common thing there is the rate in 1 year will equal the rate today multiplied by 1 plus interest or inflation in the counter currency. C stands for counter, divided by the base. Now the base is the currency quoted as a single unit. The currency quoted as a single unit. In our question, what we are working on right now is December 14, and in this we're told if the interest rate in the home country of PZK is 4%, calculate the annual interest rate in the foreign currency implied by the spot exchange rate and the 12-month forward rate. Now, I'm going to create something just to demonstrate how this works. And I'm going to do it, remember that 4.312 and the 4.208. But the future rate, you see that, equals spot rate, and we're looking at interest, multiplied by 1 plus interest in the counter, divided by 1 plus interest in the base. Here, the base currency is the dollar, because that's the single unit. And if we took that 4.208 and multiplied it by 1.03 and divided it by 1.04, it would give us 4.168. Okay? Now, that's not what we're asked to do, but I'm just showing you how it works. What we're asked to do, and I'm going to move away from here, what we're asked is if the future rate equals 4.3132, and we know that that is because the spot rate is 4.208 multiplied by 1 point we don't know divided by 1.04. Well, we are asked what is that figure, because it says what is the interest rate in the foreign country implied by the spot and the 12-month forward. Okay, this is how I would approach this. I would say 4.3132 divided by 4.208 equals the same as 1 point something divided by 1.04. And if you don't believe me, look, go back to the numbers I just calculated. 4.168 divided by 4.208 should be equal to the same as 1.03 divided by 1.04. Well, let's put that to the test. That equals 0.990. This equals 0.990. So my theory is robust. 4.3132 shared by 4.208 gives me 1.025. 1.04 or something divided by that must also equal 1.025. Therefore, 1 question mark equals 1.04 multiplied by 1.025, which gives me 1.066. Therefore, the number we're looking for is 6.6%. And just to put this to the test, the current spot rate multiplied by 1.066 divided by 1.04 does in fact come to 4.3132. So it works. The answer there is 6.6%. Now, as I say, written questions are no longer required here, so discuss whether they should avoid exchange rate risk by invoicing in dollars. Yes, it would be fantastic because it pushes the foreign exchange risk to our customers, but it's dangerous because we may lose our customers. You should no longer be facing questions of this nature in the new style of exam, hence I'm going to skip over that. What I now want to do with you, and the next question I've selected, is Rose, and Rose is from June 15. This gives me an opportunity to demonstrate to you a money market hedge. So let me ask you to read June 15. Question number 1. Let me ask you to read Rose for a moment, please. I've got another receipt here, I'm afraid, but it's fine. 750,000 euros from a credit customer in the European Union in 6 months' time. The spot rate is 2 euros per dollar, and the 6-month forward rate is 2,412 per dollar. The following commercial interest rates have been provided in this question: 4% per annum, 2% per annum, 8% per annum, 3.5% per annum. Rose does not have any surplus cash. Evaluate whether a money market hedge or a forward market hedge would be preferred. Money market hedge. What do we do? Well, I'm going to show you what we do. This is a receipt. What we do is we borrow. We convert. And we then deposit. We borrow. Sorry, was that... Were you able to read that question just now, or did it get blocked off? I'm taking it you've all seen the question. We borrow for a receipt. We're going to borrow in the foreign currency. The foreign currency in this particular question is the euros, and we can borrow in euros at 8% per annum. We are going to convert at the spot rate, which is the spot rate 2.349, and we're going to deposit in our domestic currency, which is dollars, at the rate of 2% per annum. But recognize this is in 6 months, so I'm going to have to prorata that 6/12 to get 4%, and 6/12 give me 1%. Borrow, convert, deposit should be your mantra for a money market hedge, albeit this is a receipt. So today I'm going to borrow some euros. In 6 months I'm going to receive and subsequently repay that borrowing. I'm going to receive 750,000 euros, and I'm going to earn, or rather I should stress, I'm going to be charged interest. So to understand how much I can borrow, I divide the 750 by 1.04. The 750 divided by 1.04 gives me 721,154. I'm going to convert that at our spot rate of 2.349, meaning I can place on deposit today dollars of 307,005, which will accrue interest at the rate of 1%, meaning in 6 months I can withdraw, so my return from this money market hedge is 310,075, which is the all-important figure for comparison. What I'm going to do is I'm going to compare this with the money market, the forward exchange. The forward exchange, well, 750,000 euros are divided by the forward rate of 2.412, which gives me dollar figure of, just need to turn this off, I'm in a refrigerator. 750 divided by 2.412, that gives me almost the same figure, except 945. The forward will yield me an additional, the difference between these two, 870. The forward exchange contract an additional $870. Now I feel that I want to show you the money market hedge one more time whilst we're here. I'd prefer to do it as a payment. Just bear with me because I have a multiple choice question that I need to locate, which would hopefully enable me to do this, but where it is, it's going to take me a second. That's a receipt. No, I don't want to do receipt. want to do payment. Do I have the option for it here? One last look, December 15, June 15. No, guys, I'm going to create an example. Okay, I'm going to stay with this scenario. I'm going to create an example because whilst we've just seen a receipt, it's slightly different for a payment. So I'm going to stick with the scenario that we're looking at. And if I had a bigger desk, I'd be able to keep my questions nicely laid out. So, with rows in mind, this is not the question, this is for illustration purposes. A money market hedge though a payment. Now the memory recall, we still borrow, we convert, and we deposit. However, as this is a payment, we borrow domestically. And using P rows, we can borrow in dollars at 3.5%. We convert at spot, which I'm going to use because we don't have a spread, 2.349, and we deposit in the foreign currency, in the euros, is 4% per annum. That's per annum. Now, I'm going to make this up that we have a payment to be made of $200,000 in 3 months. Okay, I'm not doing a forward on this, I'm just doing this as a money market hedge, but crucially a payment. Times that by 3/12, 3.5 is 0.875%, and that is 1%. Okay, so watch what happens. Today, 3 months. I'm going to borrow some dollars, but I don't know how many yet. I'm going to convert at the rate of 2.349. I am going to deposit the euros. I don't know how many yet. What I do know is in 3 months' time I'm going to make a payment of 200,000. And I know that the deposit will earn me interest of, we said, 0.3, oh no, that's the borrowing rate, isn't it? The deposit is 1%. We can deposit in euros at 1%. So, my deposit must be 200,000 shared by 1.01. I need to place on deposit 198,020 because that will earn 1% and yield 200,000 to match that payment. At the cost of 2.349, that means I must borrow 84,300, rounding up, but I'm going to be charged interest on that of 8.75%, which means the figure for comparison, this one, is 85,037. That is the figure that you would use if you had to compare against something else. Money market hedge, let's just reconcile because I'm going to move on to interest rates. Yes, I'm going to move on to interest rates shortly, but I want to demonstrate something to you. I just want to reconcile where we've been. So in the course of the questions we've focused on, you've seen interest rate parity theory in practice. You have seen me both, or really essentially sell the foreign currency at the high rate, and you've seen me do a forward market twice and a money market twice, one with a made up question. We've not really done the derivatives, and I'll explain why shortly. But staying with rows, we now move, or in fact, let me get you to spot this. You know, one of the worst answered questions in living memory was this particular question that we're looking at now. So rows, June 15. Look at part B a moment. Look at part B and have a think as to why it was the worst ever answered question. Exam technique. Read the question. Many people did this exam and saw this was foreign exchange. They calculated the money market hedge and a forward market hedge, which is also known a forward exchange contract. And then they got to part B and they read the question as follows: briefly explain the nature of a forward. They didn't read anything else. Briefly explain the nature of a forward, because had they read the question carefully, they would have realised that it was a forward rate agreement. Now, that should have sent alarm bells, an FRA, not a foreign exchange. A forward exchange contract. A FRA is a forward rate agreement. And, so new question, and discuss how a company can use a forward rate agreement. Some people didn't read beyond there. To manage interest rate risk. You do not use a foreign currency forward exchange contract to manage interest rate risk. What is an FRA and how can a company use it? Well, I'm going to write this down. I doubt you will be required to, but just to consolidate your understanding. Briefly, a forward rate agreement an FRA temporarily fixes interest rates. Explain the nature. The nature is it temporarily fixes interest rates for a given period, starting in the future and for a short-term need. So that's the nature. How does a company use it? Well, where they have a variable loan, what do they do? Where they have a variable loan, they acquire an FRA starting and ending. And now I'll come back to that comment in a moment. And this FRA, if rates rise above the FRA level, they get a refund. And if the rates fall below the FRA level, they pay a surcharge. Now, as again I stress, I doubt you'd be required to write this, but I just want to give you absolute clarity because I'm now going to ask you to look at another question, which I'm hoping that I can find. GXJ, was it? December 15? Yes. Now we're going to extract out here. I just want to show you the FRA. December 15, there is a question here called GXJ. I'd like you to digest that question, please. And I'm going to answer part A. Perhaps all of it, but definitely part A is my reason behind doing this question. Please digest. Sorry, David, I didn't see your question. This GXJ is from December 15. December 15, question 2. When I say December 15, it's actually the hybrid paper from September, December 15. Just on the screen, as you can see here. Okay, now a moment ago, I apologise, David Zoe. A moment ago, I had written down starting and ending, and here you're not really challenged, but in case you ever are, in this particular question, what it tells you is that we've got a 3 to 9. Well, the 3 is the start month, and the 9 is the end month, because the duration is 6 months. So in this question, it said to us a period of 6 months in 3 months' time. If the examiner progresses these types of questions on and bombards you with a number of different FRAs, then you've got to understand you identify it by the month it starts and the month it ends. Further, you recognise that we would always select the higher figure for a borrowing. So what it means is the bank is guaranteeing us that we will pay not a penny more than 4.5. And what we're required to do here is what I explained to you about the FRA, but we've got to do it with numbers. Evaluate means with numbers. This could be a multiple choice question. So, what am I going to do? I'm going to do both scenarios. If interest rates rise to 5.5%, what are we going to do? Well, we're going to be charged 5.5% times 12 million euros times 6/12. 12 million times 5.5% times 6/12 is 330,000 euros. But we're going to receive a refund of 1% because the FRA lock-in is 4.5%. Times 12 million times 6/12 gives us 60,000. And therein means our net payment is 270,000. If the rates fall to 3.5%, then we are charged 3.5% times 12 million times 6/12 210,000. But we've got a surcharge, an additional charge, a gain of 1% because of the 4.5, and that will add to our cost 60,000, and that means that we're looking at 270,000. The important thing for you guys to recognise is we're guaranteed 4.5%. That's how much we're going to pay. That's what the FRA does to us. Moving on from this, we've got here now, analyse the currency risk associated with a future exchange payment and briefly discuss how this could be hedged. Well, from the information that we have available, we can only really do a forward and the 9-month forward, sorry, a spot. So at the spot rate, this 270,000 would be divided by, what are we doing here, guys? Are we buying or selling? We are buying. We are buying euros to pay the interest. So we use, and remember, we're going to use the low rate because here we buy at the low rate. So the spot is 1.7964. 1.7964 gives us a cost of dollars 150,301. At the forward, that 270,000 divided by 1.7191 gives us 157,059, meaning an increase of 6758. How do we hedge? Well, what can we do? We can do a lead payment, pay the interest early. We can do a money market hedge. Or in fact, we could even do nothing and hope that the exchange rate moves in our favour. Okay. One more question I wanted to quickly look at here. Decide whether it's worth doing. No. All right. Unless you've got any specific questions, I think it's MCQ time. Anything specific, guys? Okay, I'm going to the June 2015 paper. June 2015. And I'm going to some multiple choice questions, which we'll answer in unison. First one is that one, number 2. Can you have a quick read of number 2? Lorraine, it is June 2015. June 2015. Okay, so this is to do with interest rates. The general level of interest rates is affected by investors' desire for real return. That is correct. The real return is the underlying return when you strip out inflation. Market segmentation theory can explain kinks, discontinuities in the yield curve. That is correct. Just very briefly, going off message, but demonstrating market segmentation. I've got a mortgage and I borrowed money to buy a car. My mortgage is for 25 years. The money I borrowed to buy a car is 3 years. According to liquidity preference theory, I should be charged a greater percentage interest on the mortgage because it's for a longer period of time. but the mortgage is secured on my home, so it's a secured loan and is in fact cheaper because the home is an appreciating asset than the car, which is a depreciating asset. So in fact, the rate of interest I pay on that 3-year loan is greater than the rate of interest I pay on the mortgage. That, guys, is market segmentation theory, and that explains why we have kinks in the yield curve. Finally, when interest rates are expected to fall, the yield curve could be sloping downwards. Well, that's absolutely true. So the correct answer there is D, 1, 2 and 3. Staying with this paper, we're going to go to the question 17. And I think I'd like you to have a go at that. Yes, because it's something we've done this evening. Have a look at number 17 and have a little attempt at number 17. I'm confident that if you follow the formula, 1.02 is the counter currency, 1.08 is the base currency, so 1.415 times 1.02 shared by 1.018 gives us 1.418, which is correct answer C. Correct answer C, 1.418. Now, I'm going to take you to the September exam, and it disappoints me, if I'm honest, but going back to my strategy that it's really the section C where we're going to max our marks, and in section B we're going to just deal with any problems that we face by not getting over anxious, because as long as we can do 2 or 3 of these questions, we're absolutely fine. So to conclude our session on risk, we're now in the September paper. September paper from 2016. Can you answer 2 or 3 of these correctly? Absolutely. Can you get them all correct? I find that that is challenging in the extreme. So I'm not going to leave you entirely to do the interview your own, but I want to leave you for 5 minutes, if I may, to go to this September paper, and how I would suggest you do it in the exam is you read through them quickly, and if you feel that you can do it, have an attempt. If you can't, leave it. So I want to leave you for 5 minutes to try and make sense of these, and then we'll debrief these questions. Okay guys, we're almost at an end to the evening. I don't think that's anywhere near as nice as the valuations task, but what I do feel is nice is that in this scenario, the 6-month forward rate, be careful here, because whilst we're looking at 1.543, that is per annum. Now, their base currency is, their domestic currency is the dollar, so the dollar is the base, the domestic short-term rate, that is 1.01 because we multiply it by 6/12, and this one we've got to multiply by 6/12, that would be 1.025. So it's no different from what you've seen, except you had to prorata those rates. That gives me 1.566, answer C. You could be able to do that as long as you didn't get fooled by the per year element. As regards to the euro receipt, what is the primary nature of the risk faced by Herd? Well, we are expecting money. It's not business risk, that's for sure. There are only 3 risks in foreign exchange: transaction, economic, translation. But look up here. They are going to get 1.5 million euros in 6 months. That's a transaction, because we're worried about the exchange rate changing. So you should be able to get that one correct. It's certainly not an accounting risk. It's not about consolidated accounts. And it's not economic, because it's a single transaction, not a series of transactions. Which of the following hedging methods will not be suitable for hedging the euro receipt? Well, it's a euro receipt. A forward exchange contract is, as is a money market hedge. So process of elimination here, you're down to a currency future and a currency swap. A currency future is a derivative that is possible because it's looking at the exchange rate. A currency swap is changing or swapping for interest rate purposes with another company. So your correct answer there is D. But that is one of those questions that is on the margins of the syllabus, and I don't like them, and I don't want you to become anxious about them. This one you should get. Which of the following statements supports the finance director's belief that the euro will depreciate against the dollar? Now this is testing your purchase power parity theory. The euro will depreciate if the euro has higher interest and inflation. The dollar inflation rate is greater. Well, no. That will mean that the euro will strengthen, so it cannot be this one. The dollar nominal interest rate is less than the euro. Yes, because we want it to be higher. So our answer here is B, 2 only. So really, from this task, I'd like you to get 2 or 3 correct. You should be able to definitely get 17 correct. 18, that's a toughie. 16, as long as you read the question and prorata. And 19, as long as you map it out, you should be fine. So you should get those 3. Because the last one, I just feel that that is absolutely bizarre and absurd by the F9 examiner. Forgive me for saying that. It's just, and the correct answer if you want to know is A. But it's one of those questions that just bamboozles us. Okay, we come to time. Where are we? We are here next Tuesday and next Thursday, and we've got the delightful topics of working capital management and investment appraisal, areas of strength. Critical topics which will be in section C. From this evening, we have attempted to cover 2 of the historically disappointing topics for candidates. I hope you found this of some substance and gives you some clarification on these topics. Before I bid you good evening, let me ask, is there any clarification that you require from what we have covered this evening? Mwemba, Lorraine, Davidso, I'm assuming therefore that you're content. Please put valuations and foreign exchange into context. It's section B. On our next 2 sessions, we are dealing with topics which you must master. So in the 5 days until we next meet, please spend some time reviewing both working capital management and investment appraisal. Critical areas. Have a lovely weekend, and I will look forward to seeing you on Tuesday evening at 6 o'clock. Take care, guys. I'll see you very shortly.